Good morning, friends. In the present lecture, we are going to discuss the functioning of central banks in reality, more so in developed countries, and how they have been affecting global economy time and again, causing shocks and period of boom as well. So, what's the role of central bank? It can be underlined that Greenspan was supposed to be the most important person in US, and he stayed in the Fed chair for 16 years. President came and went, but he stayed there. And then after recession, it was Bernanke, and then Janet Yellen, then Powell. All these are shaping the global economy. So having said that, with the ongoing financial crisis yet again throwing into confusion the role of central banks, there is a possibility of a fourth era of central bank in near future. Probably when the history will be rewritten after recession, it will be around 2010 onwards. Then this will be considered as the fourth era of central banking. The three eras, a central bank has mostly been given into three areas to work in, that is price stability, financial stability, and to finance the state during crisis. And notably, what I want to underline here is that when there are no wars, when the period of stability, then the role of central banks has to be studied very minutely. So conventionally, central bank has been supposed to be ensuring liquidity and setting up of interest rate, but history shows and proves it time and again that government always intervened, especially in the developed world. Now we are seeing with the RBI as well. There is a tussle between RBI and Ministry of Finance. The tussle has been within the Treasury and Bank of England. So this debate has been going on and on. So why this debate is there? What are the various insights into it? We are going to do a discussion on that as well. So notably, the Bank of England and Bank of France, Banque de France, were created to backroll war. So, but the really interesting aspect of central banking comes when there are no wars. In this role, there are three distinct time periods that were relatively stable, interspread with a few periods of confusion. The stable periods can be categorized as the Victorian era, 1840 to 1914, the government controlled decades, 1930 to 1960, and decades of the markets, 1980 to 2007, till the recession struck the world. So, in all these periods had periods of great confusion. For example, I'm citing out one example here, that since 1914 to 1933 we saw a world war, and to bring back the gold standard. So even that the Victorian era, there were Palmer and Behigott rules. So I'm going to do it separately, all those era differently in upcoming lectures, so that I can do justice to them. And Palmer rule and what were the success in that. So having coming back to our own lecture here, the argument was, as long as the government stayed up to the market, trade will always regain its balance. There was proving enough real bills could be monetized to maintain price stability. Now why I mention price stability is because one of the rules of central bank is to ensure that there is no inflation. All this went out of window when the Great Depression struck, resulting in huge deflation. So the Great Depression destroyed the prevailing central bank model and the gold standard at that time, when its successor, the model of socialist controlled government control, was waiting to take over. Now the decades of 1950s and 1960s saw post-war national debts slowing, being reduced, and somewhat fragile foreign exchange markets due to Bretton Woods system. In the UK, the Bank of England and the Treasury were always wary of each other, and due to interest rate being low and to service the national debt as per investment, there was a need to rein in credit growth, affect which in turn could adversely affect over the bank lending, international capital movement, access to capital markets. Here I would like to stress one more point, that Gordon Brown in 1997, he just set up different departments. Earlier it was for 300 years Bank of England was main function was to look after the debt. This I'm telling you for example. The view that the collapse of 1929 to 33 was that competition between entities with the same financial system hindered financial stability. So all of this is for financial stability. So the various reasons which came up after Great Depression were that more of the functioning was overlapped, the markets were not gradually, and the convention that the government stayed of the market, everything corrects itself up. So the Bretton Woods finally came into picture, and then it has its own role. But since its downfalls in 1970 to 73, prior to the end, Bretton Woods all other economies pegged themselves to US, which resulted in higher inflation, especially for the faster growing economies like Japan. The 1970s saw confused policy making. Confused policy making, and there was a constant debate between monetarists and Keynesians. In fact, Keynesian economics was thrown out of the context by Friedman, and then later on Friedman free markets came into. But which was catalyzed was the Mexican crisis, Argentina and Brazil in 1982, and then Paul Volcker steps in. So why what Paul Volcker did to the banking Basel I norms, then 1988 he comes in, then various regulation. I will be dealing with detail. I know I'm telling a lot of things here, but I will be dealing them separately when I'm going to do era by era. So then it will be very clear to all of you that when we are going to discuss what is happening in the global economy last 150 years. So basically the scope for this lecture is quite limited. So I'm just trying to introduce you that what happens in actual financial worlds. So now the years leading up to August 2007, everyone knows that the recession stuck in October, gave the impression that bankers have become masters of the monetary policy. Alan's Greenspan was here like anything, and he gives irrational exuberance. So whatever Greenspan thought, whatever the interest rates he sets in, whatever practically zero, so whoever comes in did get a loan. So enough has been talked about recession, the causes, etc. So but what I'm trying here to say is that conventionally the impression within the markets was that central bankers has become the masters of the monetary policy. Now the recession is stuck in. So hindsight tells us that while this does terms in price stability, it does not necessarily imply the same for financial stability. So this has been one of the issues as well. So having said that, when the things get very hot, then the government usually steps in, and then it comes up with the issues like the corridor system, that there has to be a short-term interest rate for the adoption of the corridor system for the setting of short-term interest rates. And then came the red bills, private sector bills, open market operation, then a whole lot of instruments were introduced, and then it was being debated at whether central banks are equipped enough to do justice to all the role. And then the issue came up that whether we need a separate body and doing justice to it, then the balancing solution has to be thought of, and the balancing solution was come up with like that, having a MPC. So what this means practically is that monetary policy committee, it has been doing rounds in India now. So practically it can be done like painlessly. That well, now the issue underlying this is that the reason the creation of a different body for setting up of interest rates, I will come it in a while. So now again I am here. The creation for different body for setting up interest rate, such as monetary policy committee, which has its own complications. Now there can be two bodies now. Now the problem with the two bodies is that what the central bank will do if monetary policy committee does the setting of interest rate and everything. Now the apex body is in charge of maintaining systematic stability. The central banks must in charge of systematic financial intermediaries and should also have access to banks considered to be connected to systematic risk. In particular, central bank already has a role of interest rate setting, macroprudential supervision, and liquidity management. So how it would not be a very good idea if we introduce microprudential supervision. So I will be doing it in another lecture that what all these terms mean. So practically what I'm coming towards the conclusion of the present lecture is that with all the things of going up with the Volcker, the Greenspan era, and then John Taylor, Friedman's, whatever these people had been economists, very esteemed economists has been telling the global economy and the world follows it. So where we end up now, apart from macroprudential policies, prevention rather than cure has come with their set of own difficulties. Even if it was so simple to come up with an MPC and then everything would be resolved, it's not that easy. The first is defining how exactly the system of early warning that predicts a crisis. Now early warning system, Bernanke was very fond of these. Several attempts has been made by the World Bank and the IMF, but they still fail in what they do not provide warning system when the action has to be taken. So still a global economy is an experimenting stage, even after lots of years, lot of crises we have seen. So the fourth era banking will be very crucial. So looking forward to you for your active participation in the next lecture. Thank you so much for listening, and please do write to me, and we're looking forward towards more. Thank you very much. Thanks for listening.